great panel, very interesting topic, and I guess I'll first allow everyone to just quickly introduce themselves, and then we'll get right into it. So, Bill Reichert, head up the corporate practice in Charles Russell Speechlys for the Middle East.
Owen, Waft, Chief Legal Officer at Gargash Group.
I'm Khuram, Maqsood. I work for Houlihan Lokey. It's an American investment bank. We're global. We have locations in 36 cities, and I'm based here in Dubai.
I'm Nichol. I'm a senior partner at Lumina Capital Advisors. We are based in London and Dubai, and we work in the mid-market M&A across the GCC and the Europe.
And I'm Munal. I'm Director and Head of Middle East and Africa for a specialist M&A insurance broker, HWF. 70 people globally, 8 offices, London, New York, Dubai, and Paris, to name a few.
So just to give a little bit of context, the importance of M&A to the global economy. Did a little bit of research, and the global value of M&A in 2023 was somewhere around $3 trillion, okay? And that was actually down about 15% from the previous year. The height of M&A was $4.5 trillion. That was back last decade. And in the MENA region, it accounts for about $80 billion worth of activity. So it's sizable, it's important, it's a big part of the economy. And we've heard a lot today, and well, we've been hearing a lot over the last several weeks, several months about turmoil, whether politically, economically, et cetera. And so I'd like to turn, Khuram, first to you, and maybe you can just tell us a little bit about what you all are seeing globally in terms of the environment, in terms of trends, and what you expect to see over the course of the next year or so.
Sure, absolutely. It's great to be here, and thank you everyone for joining. Just building on what Bill said, the M&A market is broad, it's deep, and it's reliably stable. Over the last decade or so, we can reliably count on the M&A market to deliver about 30,000 to 40,000 transactions on an annual basis at an aggregate transaction value of between, call it $3 trillion and $4 trillion. Of course, there has been growth in this market. It's partly a function of the participation of private equity, which once upon a time used to be about 3%, 3, 4, 5% of the global M&A market in the year 2000, for example. And now it represents about 30 to 40% of the global M&A market. And, Houlihan Lokey is very active in global M&A. We are probably the largest M&A banker serving the US and global mid-market as defined by transactions that are sub-$1 billion. What's interesting about the circa $3 to $4 trillion of M&A transaction value is most of that are small deals. Over 75% of M&A transactions are under $100 million. About 98%, if not 99%, of M&A transactions are under $1 billion. Most of us talk about the big deals. We talk about RJR Nabisco, we talk about AOL Time Warner, but those are a tiny proportion in terms of count, in terms of the overall landscape. Most of M&A is small M&A. Most of M&A is mid-market M&A. In terms of trends, as you correctly pointed out, Bill, 2021 was a banner year. We had done or the market had delivered about $4.5 trillion of value at a record high transaction volume of over 45,000 deals. Since then, we are probably down 35%. And the likely catalyst for that, as most of us know, is interest rates. Interest rates had a historic rise in the middle of 2022. And although corporate M&A wasn't that affected by it, corporate M&A is driven largely by strategic imperatives. But private equity froze. Private equity essentially stopped in its track. Buyout deal values dropped from $1 billion in 2021 to $400 billion. $1 trillion in 2021 to $400 billion. That's a 60% drop. And that caused a substantial slowdown in the overall M&A market. The good news is between peak, which was 2021, and trough, which was 2023, the worst appears to be behind us. We are probably, turning the corner this year. Most indications are that M&A this year has gone up both in terms of value and volume by about 10 to 15%. And this is a function of a bunch of things, including moderating expectations on interest rates and other dynamics at play within the private equity industry in which we're very involved. I think the outlook is good. And 2025, 2026 are arguably going to be, nearer to the top of the cycle again. So.
Great. Well, that's good to hear and encouraging. Andrew, I'd like to turn to you because I know that you guys recently published a study that I believe you do annually that focuses more on the region. Are you guys seeing some of the same trends and hopefully some of that same optimism for the future?
Yeah, I think I'd echo the same sentiments as Khuram. The last 4 years globally in M&A has been extremely challenging. Volumes have been substantially down, but that's not what we've seen in the Middle East. Khuram talks about the middle market, that sub-billion-dollar deal. We've seen a dramatic increase, and we call the mid-market in the Middle East. It's probably we called lower mid-market in Europe and the US, that $50 million to $300 million. And the survey you referenced showed that real positivity. We as a business have grown quite substantially in the last 3 years in the region. And we had a survey where we asked over 300 of our clients across the region and in Europe about what they thought about Middle East transactions. And more than 70% of those respondents expected more M&A or the same levels of M&A over the last year. And I think that's driven by two things. We're seeing not just outbound transactions. If you think about Middle East or GCC M&A, you think about those mega deals, and we've just seen one. We've seen ADNOC and Covestro that closed 2 weeks ago. But we're not just seeing the outbound deals, we're seeing inbound transactions as well. So transactions from the UK, investors from Europe coming into the Middle East. They could be through JVs, providing access to the region and really getting access to those mega giga projects, infrastructure investments, retail. And I think one of the ways to get into the market is through M&A. So that's why we've seen that increase in mid-market transactions. And if I look at the specifics of why we've seen more deals in the region, why that trend has slightly been bucked compared to the global doldrums of M&A. Over $2 billion went into venture capital investments between 2019 and 2022. That's a lot of money. The best companies that have come out of the other side of that are now looking for growth capital. That is mid-market M&A. They're attractive to private equity firms, they're attractive to corporates. If you're in agri-tech, if you're in ed-tech, that money is now looking, it has to go somewhere. So I think the growth in that post-venture capital world has been extremely positive. The second reason is, I mentioned that Covestro deal. That's the second deal that we've seen that they've operated in the region, and the buyout by ADNOC was a multi-billion-dollar transaction. But that's an example of diversification, yes, expanding globally, diversification of revenues, but also the ability to localize and bring back skills and technologies back into the region. So you're diversifying out, but also bringing skills and tech back into the region. And thirdly, I would say it's the creation of regional champions. So we look at technology, we look at AI. If you look at what's happening to some of the large telcos like Zain and Etisalat, they're creating these regional champions across the region. It's not just in one market anymore, it's that diversification as well. And M&A is really a great way to do that. So I think that's what we've seen in the region. It's not just the outward, it's inward as well.
Thank you, Andrew. A couple of interesting themes here. One, just generally that it's the mega deals that always get the headlines, right? Like the ADNOC acquisition or some of the others. You don't read about some of the smaller mid-market deals. But as we can see, that's really what drives the market. That's what drives growth. And related to that, one thing that is very interesting about this part of the world is the importance of family businesses. 90% or more of the businesses in the UAE are owned by families. And so I thought it would be helpful to have the perspective of you, Owen, working in a family business to try to understand, what a family business looks for. I mean, obviously every family business is different, but many are going to have similar themes. And what are some of the themes that you see when the Gargash Group is considering acquisitions?
Yes, I think similar themes. I mean, all
the standard M&A rules apply to a family business. It's just the family perspective is sort of a layer on top. And it's all about, it's really all about culture is the additional layer, because you've got businesses where you have stakeholders who have a much greater degree of influence than in an ordinary non-family business. And the key is alignment of the family's values and their culture. And so you have to do, if you can, a sort of cultural fit assessment when you're going into it. And it's a very hard thing to do, but it's an essential part of it, because if you don't get that cultural fit right, it'll not go well. The other thing you're looking at as well is reputation and legacy. A family's reputation takes years to build up, and you can lose that in a few days. And so doing a pre-acquisition risk assessment is another thing you're going to try and do. It's difficult. You can loss of reputation can come from an undisclosed matter in due diligence, but also it can come from a failed transaction, an acquisition that's done that hasn't gone well, because the market is small, particularly here in the Gulf. And what might be an attractive, profitable business that doesn't work because before acquisition, and it's a small market, and everybody will hear about it, even if you think it's a private affair. There's an additional layer on top of financial due diligence, which is what the family's risk appetite is, and whether there is an additional financial risk burden from acquiring that company. Does the company fit into the risk-reward matrix of the family? Or perhaps it doesn't, or maybe in the future there's going to be a significant capital appetite. There's also issues like succession, next generation involvement. What are their roles going to be in the expanded group? Governance is another issue. The governance in a family business is very different to a non-family business, because you often have one or two very influential decision makers. And is that governance framework going to sit nicely? Is it going to be too tight on the new business or too loose? So it's cultural misalignment, reputational risk, financial risk appetite, but also what you've got to look out for ahead of the deal is whether there are different opinions amongst the family members about the direction and the fit, because those discussions are very different to a board discussion in a non-family business.
Okay, interesting. So obviously there's a lot that goes into the mix, a lot that goes into the consideration, and a lot that can go wrong. And that's what can make the negotiations very difficult. And quite frankly, as a lawyer representing clients, that's where clients often are very concerned, because they don't want their legal bills to go crazy. But at the same time, it's important to protect value. It is a big risk for any company to make an acquisition, because often it does go wrong and you can end up with problems. So what happens is a lot of times the lawyers will spend a lot of time, sometimes in my opinion too much time, negotiating the potential liability that can arise if a deal does go wrong. Munal, could you talk a little bit about sort of what you guys bring to the table in the sense, WI insurance is something that is very well known in other markets. I would say more mature markets, and I guess that's true, but I think this already is a fairly mature market. I guess there are just some markets that have more of a history of it. But tell us a little bit about what it is, what it can do, and how it can help facilitate transactions, and maybe most importantly, try to reduce some of the time that you have to hear the lawyers going back and forth over warranties and indemnities and things.
Yeah, for sure. So I guess to set the scene for people who haven't used or seen insurance on any of their deals, I think there's sort of a couple of different products that can help with hedging that risk for sellers or investors. The first one is for stuff that comes up during a DD process. So it's an item that is an issue. For a seller, that means one of two things. One, it's a price chip, or it means that some cash is going to be held back post the deal. Now, the antithesis of that for a bidder, if it's a competitive process, is that's something that they have to ask the sellers for that makes their bid uncompetitive. So that's the first piece. And then the second one is the W&I and the more vanilla or reps and warranties if you're in the US that people know about. And that is for those unknown and unforeseen risks that frankly post-deal can really devalue an asset. And the idea of the insurance is to hedge those risks and to have a third party, A-rated insurance company that takes on that risk so that it doesn't sit with either the seller or the buyer. And I think the key point also that you made is it is supposed to limit the amount of time that the lawyers or the bankers are spending negotiating those points. For all of us that have negotiated deals, I did that in my past life as a corporate lawyer. These are the two items that always take up the most amount of time. I think what's really interesting about the product is that it has value across the investment life cycle. So, Owen, you were talking about those family-owned businesses. And actually, if we think about it when they're divesting, because we've been seeing that quite a lot, these quite big family conglomerates that are now thinking, actually, no, I'm going to divest of non-core assets and focus on what I'm good at. And, for them, an indemnity item actually means quite a lot, having to stand behind that. So there's value at that end. But then when you look at those big PE sovereign exits, they want to go out to market and say, this is my full IRR. I haven't had to hold anything back. And the W&I allows them to do that. It allows them to have that full exit. So I think that's what's interesting for me, that it goes throughout the life cycle. I think there is a perception, though, that this is a seller-friendly product. It allows sellers to metaphorically go and fly off into the sunset, which it does. They can take all of the upside and none of the downside. And I say that even where they have to pay for some of the insurance, because it is a fraction of what they would have to hold back. But actually, a lot of my clients approach us on the buy side, and there is genuine benefit for buyers or bidders. I think two things that I think are really interesting in the region, and what we've been seeing quite a lot is, you mentioned that it is growing as a market. The maturity, we're definitely seeing it, right? A lot of the big funds, or even some of the family groups, right? They've hired investment professionals from PE funds in Europe, and they're making their processes more sophisticated. One of the ways that we've helped a lot of international investors coming into the region is to enhance their bid. If the sell side hasn't proposed, for example, W&I, going in and actually structuring a bid that has W&I has allowed them to win assets. And as I said, we've helped a lot of international clients do that. But then the second one, and Owen, you touched on this, and I think it is so important, and I see real value for the product for this reason, is it's a small market. When you are doing regional deals, or even outbound assets, but you have got a regional seller and a regional buyer, the idea of bringing a claim against somebody who you have a relationship with outside of a deal process is just not something that a lot of my clients feel they can do, but they want to realize real value from their assets. And the way that they can do that is by having a third party, an insurance company that they can claim against. I think there's lots of other ways it facilitates. If you've got a disparate shareholder base, or you have got a fund that's unwinding, that's a typical example. There's lots of ways that the insurance at that beginning bit can actually bridge expectations between the sellers and the buyers.
Okay, thank you, Munal. I'm already being told that we're getting a little bit short on time, so I just want to give everyone a minute. Maybe, Andrew, we could just go to you real quick. I mean, we've heard a lot about, the future. We've had interest rates cuts lately. Obviously, we've got a big election in the U.S. coming up. Tell us a little more about what you see going forward and how some of those risk factors will play into things.
I think the Middle East starts to compete globally. So we talk about a number of deals happening, probably significantly less in the last 3 years than there were a decade ago. But globally, the Middle East now has to compete on the global scale for board time, for transactions, for scarcity of capital. So yes, there are geopolitical risks. We've got elections in the US. But the reality is that the Middle East is now in a position where it can start to compete globally. It's had it fairly easy on the deal front for the last 2 to 3 years. But I think for me, what's exciting is now those opportunities to start competing for global capital when it's not just transactions in the Middle East. So I think it's going to be another exciting year for deals in the region. I think particularly Saudi. I think our survey showed it was Saudi and the UAE. And I think what's really exciting is it's not just one-way capital. It's cross-border capital flows as well. And where the capital flows, you tend to find the skills and the talents follow as well.
Okay. Khuram, do you have any thoughts to add?
Yeah, so I guess just in terms of the global scene, you know, as I mentioned, 2023 is probably the worst of the, you know, the movements within the M&A market. We're up already this year in 2024. Interest rates, you know, Jerome Powell has cut interest rates this year. The ECB has been very active, and of course, moderating interest rates are releasing some of the flow within private equity, which as a buyer and a seller are much more interest rate sensitive. So, you know, that's one source of activity that we can expect. The other is, you know, over the last 24 months, as I mentioned earlier, private equity has been frozen. And that means that on the dry powder side, private equity funds are sitting on approximately $1.2 trillion of dry powder, which is yet to be called. A quarter of that dry powder is about 4 or 5 years old. So, you know, this kind of money is on a clock, and so it has to be used or they lose it. So that's going to be another driver of M&A activity going forward. And finally, you know, given the freeze in private equity activity over the last couple of years, the inventory of portfolio companies has been expanding. Holding times have gone up from 4 or 5 years to closer to 6, 7 years. And so there's a lot of pressure, certainly from LPs, to return capital. And, you know, it's probably over $3 trillion of asset value across 28,000 portfolio companies that need to be exited. So, you know, between dry powder sitting, unexited portfolio companies, interest rates coming down, and all the evidence that we see in terms of, you know, the banks returning to the market and competing with the non-bank lenders, again, reducing the cost of financing, the outlook looks encouraging. And I would say this was a transition year, and I think next year, you know, we'll be back up again in terms of the M&A cycle.
Okay, thank you very much. I'm being told we have to wrap up, but I just want to, Owen, give you a chance. If there's anything you want to talk, you talked about some of the integration problems. I don't know if you want to take, if you can do it in a minute or so and maybe talk about, sorry.
Well, no, to sum up what I was going to say is if I was going to talk about trying to make sure deals don't fail afterwards. And the key thing, it's all about failure to integrate the business. And so the key thing is a comprehensive integration planning stage and setting up, which is what we do, an integration management office ahead of the deal so that when the deal signs, you are good to go. There you go. That was
Thank you,
under
Owen.
a minute.
Munal, if you can do it in 30 seconds, give you the last word.
Okay, just very quickly, I think insurance, question we always get, does it pay out? Yes, it does pay out. There are two things that matter to investors when there's a breach of a warranty. How quickly will you get paid out, and will you get the quantum you want? We did a big study last year. The answer is claims get paid out, 90% get paid out in 2 years, which is far quicker than on an uninsured deal. And circa 20% of payouts are for more than 50% of the limit. And the final one, I know we're running out, but the study showed us that 40% of claims relate to seller non-disclosure, fraud, or third-party claims. You cannot DD for those things, so there is value in the insurance.
All right, well, we are out of time. Thank you to my fellow panelists, and thank you all for listening. And let's hope that the coming year is a good one. Thanks very much.